Hi, I'm Jon Guest, and again I'm just going to do a little short video clip to go through some of the questions from the November edition of the Economic Review. So in this edition there was a question on interest and whether it was usury, and at the end there were three questions, and there was a small little diagram on the market for loanable funds. And that's what we've obviously reproduced in this diagram here. So on the on the x-axis we've got the quantity of funds, and on the y-axis we've got the rate of interest. And effectively here we're just assuming that there is only one financial market. So all the savers who want to save their money, they go to this market, and if any firms or individuals want to borrow money, they also go to this market. And obviously in the real world there's lots of different types of financial institutions, but we're just going to simplify and build a model that simplifies from the real world to try and focus on some of the key issues that we want to look at. So question one in the November 2015 issue was, what would be the equilibrium rate of interest and quantity of loanable funds in a free market? So again, we're just going to use our normal tools, look at any market. We're going to have a demand curve for loanable funds. So we've drawn that here. So this is either individuals who want to borrow money. This could be to get a mortgage to buy a house. It could be they want to borrow money to build a kitchen or an extension or buy a car. Or this could be firms who want to borrow money for investment in their business. Again, we'd expect this to be downward sloping as the rate of interest, and just to focus on this a minute, this rate of interest here is the real rate of interest, not the nominal rate of interest. So after we've adjusted for inflation, we would assume as the real rate of interest fell, this would make borrowing more attractive, and more people would want to borrow, and there'd be an increase in the quantity demanded for money to borrow, to invest. We can also add a supply curve onto this diagram, and effectively this is the supply of loanable funds. So you can think of this now as people who want to save some of their money or lend it directly to others. So if you're a household and you've got some of your income left over that you don't want to spend, you want to save, you could actually lend this directly to a business, and probably the most common way you do this is to buy a bond in that business. Alternatively, you effectively lend it to businesses in a more indirect way, and obviously simply what most savers do is place their money in a bank account, and then the bank then uses that money to lend to businesses or individuals. And again, we'd expect this line to be upward sloping. As the interest rate increases, it's going to make saving more attractive. Effectively, it makes the opportunity cost of spending your money greater because you're going to be missing out on an ever higher rate of interest. So now we've set up our market for loanable funds, what would be the equilibrium, which is the focus of question one? Well, again, it would simply be where demand equals supply. QC would represent the equilibrium quantity of funds that were saved and borrowed, and the equilibrium rate of real interest would be RB. Obviously, if the rate of interest rate was above RB, so let's imagine it was RC, at this interest rate we can see here that the demand for loanable funds, this is people who want to borrow money, again it could be individual consumers or firms, this has fallen because obviously at the higher interest rate it makes borrowing more expensive, and that deters some people from wanting to borrow at this interest rate. So the amount people would want to borrow would be QB. Again, the amount people want to save, if we read that off the supply curve, this would be QD. And we can see at the high rate of interest, this is attracting more people to save. So we've got lots of people who want to save or lend their money, and this is greater relatively than the firms that want to, or the individuals who want to borrow the money. So with the supply of loanable firms being greater than the demand for loanable firms, this would put downward pressure on interest rates. Again, if we had a lower interest rate, RC, if the interest rate was below the equilibrium level of RB, then we can see here that the supply of loanable funds would be lower. At the lower interest rate, less people want to save. Obviously, the low real interest rate makes borrowing more attractive, and we can see here that borrowing, the amount people want to borrow at this interest rate will be QE. The amount people want to save is QA, so people want to borrow at this interest rate far more than the amount people are saving, and this is going to put upward pressure on the interest rates, and obviously the interest rate would be pushed up towards RB, the equilibrium level. So hopefully that gives you a nice answer to this question. What we'll do in a separate video is go through question 2, and in another separate video, short video, go through question 3. So I hope you found that useful.